You or me? Let's look at your chart, mate.
My iconic monetary policy checklist. And here it is again for everybody to see. And let's go through it, Mark.
Go for it.
And you'll see, I'll give you the answer before we start, why interest rates are on hold and why financial markets are pricing in just a possibility that the next move in rates is down. Not yet, not for a year or so, but just in the middle to latter part of 2024, it might be down. Here we go. GDP. It's really weakening. There's no question that it's slowing down. It's neutral. It's not bad yet. In the next couple of quarters, it could well move to the easing camp.
And they like to see it, governments or RBA likes to see GDP between 3 and 3.5. Correct.
Yeah. Possibly a little less with our ageing population. But yeah, but at the moment, we're heading for GDP of 1.5. We haven't got there yet, but we'll do that next month when we get the updated numbers. Inflation, I'm going to put tightening to neutral. It's coming down sharply around the world. Commodity prices are down, and while petrol prices have shot up a bit, there's more to the inflation story than just petrol. If that was the only thing in the whole checklist that we'd be looking at, you'd say there's a bias to hike, but as we'll see, there's more than that. Labour market, I'm moving to right all the way to neutral. That fall in employment that we saw in July, the uptick in the unemployment rate, the fall in job vacancies, the fall in job advertisements is suggesting to me that the labour market's still okay. It's not in the easing side yet, but it's starting to slow down.
Well, especially given when the RBA governor-elect has said, we want 4.5%.
Yep, and we're on our way to get it,
so
by the way.
Trending that direction.
Yep, and if it gets there in the next 6 months, she'll be happy, we'll be happy, she'll have hit the inflation target more easily.
Well, who won't be happy is 140,000 people losing jobs.
That's the issue, yes. Yeah, indeed. Wages, as we spent a bit of time discussing, 3.6% annual growth in wages, no problem. Not a problem in the world.
Right,
perfect.
Right territory.
It's sort of like not too hot, not too cold,
it's
just
Goldilocks.
Right. Goldilocks wages growth. Yeah. International economy, I'm going to put almost in easing. China is very weak, our major export market, but the US has been surprisingly resilient in the last month or so. A lot of the data that we've seen on their labour market, on their bottom line GDP numbers have been a bit stronger. Same in Europe. Europe's slowing down, but it's not catastrophic. So it's sort of towards easing. And the markets in Europe, US, Canada, UK, or UK's got more rate hikes. They're slightly different. But they're sort of a little bit like us. Probably not another rate hike, but they're not quite ready to price in rate cuts. So they're putting that towards that end of the side. House prices, they're going up after falling. I'm putting that just in the neutral camp. You know, they're neither up nor down. They went down 9%. They're up about 5 or 6%. There's a bit of pressure. There's pressure on rents, as you discussed.
But let's qualify that, though. There's also, we're not in a normal market. So
correct.
The normal supply demand is, in other words, demand is not going up, just that the supply is going down.
Correct. We've got poor levels of supply.
And I would like to quickly explain that because, in terms of assessing demand, the thing that creates demand is affordability, and affordability is out of control because we now assess people's borrowing capacity at nearly 10%. So as a result of that, we can lend less or we don't lend at all. And therefore the demand curve or the demand, the demand curve is nowhere near where it was a year ago.
Correct.
But the supply curve has also sort of dropped. So where the two meet on the x-axis should show a lower price, but it's not yet.
And there's just a hint again. Remember the spring selling season is usually when there is a bit of seasonality in house prices, no doubt. So we've got the big selling season. There's new listings. The data from CoreLogic and SQM research showed new listings have gone up unusually strongly.
Yeah.
And a bit of discussion about investors getting out, that they're investors having to, even though they get negative gearing benefits, they still have to pay the interest costs and all this stuff. So there's evidence that there's a bit more supply coming onto the market. So house prices, I've got to be neutral.
And I think that's right place.
You wouldn't hike rates, you wouldn't, about neutral. Retail sales, shocking. We consumers, and I'll put consumer sentiment in that. We saw all the Westpac consumer sentiment. We saw the retail sales numbers come out from the Bureau of Stats. Retail spending now is lower than it was in October last year. So people are hunkering down. We consumers aren't silly. Cost of living pressures, interest rate pressures, and now just the hints of a weakness in the labour market. What are you going to do? You're going to go out and have that fancy restaurant meal. You're going to buy, that fancy sort of holiday away. Well, look, let's just hunker down, stay at home. So retail sales are really weak and sentiment's pretty bad. Building approvals. Well, that's the supply of dwellings. Too
Down.
low. Interest rates are a factor in property developers'
Totally.
decision to whether I'm going to build that series of townhouses or I'm not. Well, if interest rates are up here and my cost of borrowing money to build these townhouses is so high, I'm not going to build them. So we need, and they're really weak. Business investment, it's doing okay. You know, there's a catch up from the COVID when a lot of businesses shelved machinery and equipment purchases and building warehouses. That's actually doing okay. The Bureau of Stats data on business investments, pretty good. Same with business confidence. It's come down a bit as the economy slowed down, but unlike consumers who are feeling pretty miserable, the business sector is, I'll call it okay, and that's why it's neutral. It's not strong, not weak. Another one of those ones that's in the middle. Commodity prices, well, they were falling. We noticed, you fill up your car with petrol, $2 a litre now, thereabouts. Did get down to about $1.70 a couple of months ago. So commodity prices were down. They've gone up a bit. You know, China's slowing down, the iron ore price, things that matter to Australia, they're sort of all over the place. So I'll put that in neutral. Stock market. I'm going to put that cheekily in neutral to tightening because it's actually really resilient. The US, the NASDAQ, you know, with all these tech stocks, all these crazy, you know, chip makers and things doing really well. And not say the hike rates because the stock market's strong, but it says to me that if there was a hike, and okay, the market would probably drop a bit, but it's dropping from a level up here, not down here. And finally, current rates, I'm going to put that in the neutral to easing side. Our 4.1% cash rate, 400 points of rate hikes in the last 15, 16 months or so. Policy's tight. The RBA acknowledged that policy is restrictive. To get super restrictive, you'd need some of these discs to come back to the tightening side of our checklist.
So you're going to say nothing, no change.
Most of them are here, slight skewing to easing, but for the rate cut decision to be realistic, and it's not. I just want to emphasise this. We are not about to get a rate cut. If we were to get a rate cut in 9 to 12 months, this inflation marker has to go back to neutral or even easing, and that means inflation, not just for 1 quarter, 1 month at 3%. It's got to be 2.5% or less. We're not there yet, and we may not be there for a year. But the critical thing about the rate cycle or a cutting cycle is inflation. A hiking cycle is postponed when you get the bulk of these other ones neutral to easing.